Right, welcome to this lesson. This is my very first lesson on the stock market crash course. So, if you are looking to invest in the stock market and you know absolutely nothing, this is the dummy guide to stock market investing. All right, so let's get right into it. All right, in this video, I'm going to be talking about stocks. What are stocks? Then from there, we'll move on to what is the stock market, and then we'll go into the two major types of stocks, which is the ordinary stocks and preferred stocks. Then I will look briefly at other securities that are traded or associated with the stock market, and this includes index funds, ETFs, bonds, and mutual funds. So the UK stock market, the USA stock market, and all these other stock markets I will look at in the next video. All right, so a stock is actually a security, and it's also known as an equity. It's a security that represents ownership in a fraction of a company or a corporation. This entitles the owner to a proportion of the corporation's assets and profits. So when you're buying a share, imagine you are actually buying a portion of the company. If you think this way, your investing will actually become better, as this is the analogy that I would want you to have in your mind when you buy stock. So units of stock are called shares. So you can find people saying, I've got Tesla shares, I've got Apple shares. They mean exactly the same thing. Stocks, shares, sometimes people call them securities. The stock exchange, this is actually the platform where people connect to buy and sell shares or stock. Although there can be private sales as well, which are known as over-the-counter. I don't want to complicate things that much, because I want the very, very beginner investor to understand. This is a dummy guide, so I want to keep it silly simple. That's the KISS principle. Keep it silly simple. Okay, so these transactions have to conform to government regulations, which are meant to protect investors from fraudulent practices. And in the USA, you've got organizations like the SEC or the SEC. I always call it the SEC. But yeah, it's the SEC, which regulates how how people trade these stocks, and they also regulate if insider trading is going on, because that's fraud in the stock market. So we've got two types of stock. One, the ordinary stocks, and then two, we've got preferred stocks. So I've got the wrong spelling there. Forgive me, my bad. A bit of hangover there. But yeah, we've got ordinary and preferred stocks. So these stocks, I'll just explain them in the next two slides. So ordinary stock, also called common shares, are stocks sold on the public exchange. Each share of stock generally gives its owner the right to one vote at a company shareholders meeting. So you've got voting rights in an ordinary stock. In preferred shares, the owner of ordinary shares is not guaranteed a dividend. So that's the major difference between ordinary and preferred stock. So preference shares are more commonly referred to as preferred stock, and these are shares of a company's stock with dividends that are paid out to shareholders before the common stock dividend. So if you want to remember this, just remember that the owners of preferred stock have preference when it comes to dividends. So that's the major difference between preferred stock and common stock. Also, preferred stock shareholders also typically do not hold any voting rights, so they don't have any voting rights. So common shareholders do have voting rights. but they don't have preference in terms of when they do receive their dividends. So this is the difference between ordinary and preferred stock. So ordinary shares, you've got voting rights, they pay dividends after preference shareholders. You can pause the video and read this slide for you to be able to get a better understanding. But the major difference is that preference shareholders get dividends before ordinary shareholders. Preference shares don't have voting rights, whilst ordinary shares have voting rights. So these four are the other instruments traded on the stock exchange. So I can call them instruments or securities. It's one and the same thing, securities, instruments. So don't be confused by that. So we've got index funds, electronic traded funds, which are known as ETFs in short. Then you've got bonds and mutual funds. So I'll explain this a little bit as we go. So index funds, this is one of my favorite investments. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. So this index could be the S&P 500, the Nasdaq, the Dow Jones, the FTSE 100, the Nikkei, and all these other indexes. So index funds have lower expenses and fees than actively managed funds. Index funds follow a passive investment strategy. So this is the major difference between an index fund and a mutual fund. An index fund is passive, whilst a mutual fund is active. They're actively managed. An ETF or electronic traded fund is actually offers you a way to invest in a wide range of bonds or shares in one package. They also track a specific market like the FTSE 100. So they are very similar to index funds, which also track a market's performance. So the difference, you might be wondering, comes down to the way they are traded. An electronic traded fund actually uses real-time trading rather than a mutual fund which gets priced at the end of the day. So a bond, these are one of the safest investments out there. Bonds are loans taken out by a company or a government. Instead of going to a bank, a company will get the money from investors who buy its bonds. In exchange, the company pays an interest on that bond. So the company pays the interest at predetermined intervals. It could be twice a year, or it could be once a year, and that's annually. So bonds are less riskier than stocks, but they are sold on the secondary market. And when I say secondary market, I mean you can't go to a government directly and buy a bond. You have to go to the intermediaries who are brokers like PIMCO, Vanguard, Fidelity. Those brokers out there, they would have actually bought those bonds from governments or companies, and then they will then on-sell them to retail investors. Brokerages often package their bonds into ETFs or index funds and trade them on the stock exchange. I've actually got a couple of these bonds in my portfolio. Mutual funds, these used to be my favorite, I think 3, 4, 5 years ago, but yeah, I think they're out of fashion now. So mutual funds are investment strategies that allow you to pull your money together with other investors to purchase a collection of stocks, bonds, or other securities that might be difficult to recreate on your own. So this is often referred to as a portfolio. So the difference between mutual and index funds is that they are actively managed, whilst index funds are passive. So mutual funds, I can give you an example of a mutual fund. The fund that was run by a guy called Woodford, or was it Woodward? I'm forgetting the name, but yeah, you get people like Peter Lynch ran a mutual fund at Fidelity for a very long time, which performed really well. I think he made 20% annualized for like 20 years. It was a very good run. All right, so we need to understand what risk and reward is. We need to understand the relationship between risk and reward. So this relationship is a direct correlation, which means relationship between risk and reward. So the higher the risk, the greater the likelihood of reward or loss. Take it this way: if you're going to deal with cocaine, I don't know if you've watched the TV series Narcos, but that guy had enough money to actually buy the country's public, all of it, just from selling cocaine. But cocaine is a risky business, so he made a lot of money, yes, but the risk was very high, because anytime he could lose his life, you've got gang wars, you've got people fighting for turf, you've got the police coming after you, monitoring your every move. So this is risk and reward. You've got return there, and you've got risk. So the higher the risk, the higher for potential return. But you can also make a loss, you see. So don't just look at one side of the coin. With higher risk comes higher returns, but also the likelihood of higher losses. If you are dealing cocaine, you run the risk of being caught, being put in jail, or losing your life to enemy gang. So this is it for today. I hope you enjoyed this lesson. If you did enjoy, please give me a thumbs up and like this video. It will help me, and it will go a very long way in making my video be discovered by other people. Thank you very much, and goodbye.